The month of May saw a spur in futures and options trading, with small investors reportedly driving volumes. This comes despite warnings by SEBI about 90% of investors losing money in the options market. My colleague Sakshi Batra spoke to market analyst Shailendra Bhatnagar about this resurgent trend and how small investors can save their money.
The market regulator has been constantly asking brokers to, constantly advise all the inexperienced retail investors on every trade that they incur on the option space as well. If you could list out the broad 3 or 4 key risks that one should be aware of before one gets in here, so that, every viewer who is interested in this space thinks twice.
Yeah, so Sakshi, first things first, if you can stay out, you should. If you are new to this market, it's best not to trade options. I say that with grave responsibility on my end, because this is not a market meant for an immature investor. Unless you've seen the market cycle for 3-4 years, you should not be trading options, point number 1. 2, you must realize, Sakshi, in the last 5 years, we've seen very heavy automation happening in the world of options. That means a lot of very high co-location servers who are running on algos, they spot the trade much earlier than a retail investor like you and me does. And by the time you get into the trade, the meat of the matter is over and you're held, you buy an option at a very high premium, which you ideally should not. The volatility that you see in options trading has been sucked out by all machines, all algos. And this comes at a time when retail participation is rising. So the reason for the loss that retail investors are making in options trading is because they are up against machines. Machines are fast, they have no emotion, and they execute a trade in 1/10 of a nanosecond.
Correct.
So you have to be very clear in your mind what needs to be done.
What would you really advise in case one still wants to go ahead and participate in this space? What is the best way to hedge your positions and be on the safer side?
On the option side, to hedge that. So it's basically a safety net. You are trying from 18-story building. The Nifty is at 18,000. So imagine you are on the top of the 18th floor and you take a leap of faith hoping that you'll reach the 19th floor. But Newton's gravity pulls you down, and that is where the option hedge is. You buy a put or you sell a call along with the long future. So at that point of time, when you're falling down, the option acts as a hedge, a safety net. It protects you from making more losses. If you lose 200 points on the Nifty, your futures transaction will be 17,800 minus 18,000 into number of lots, right? But the cost of a put at that point of time could be 40 rupees, which may rise to 60 rupees. So you make a lesser loss. Ideally, in the real world, when options were launched, they were a hedge. Sadly, people have now gone into the market of just that hedge and playing that in a very serious manner. And that's a very, very dangerous thing.
If you like the video, do like, comment, share and subscribe.